401ks are well known as company retirement plans for big companies, but there are ways that a small business and even a sole practitioner can use a 401k to maximize their retirement savings. And that's what we're going to talk about on today's episode of Friends Talk Financial Planning. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois. And we've got a special guest today, which is Sean Mullaney, and he's going to introduce himself in a second. But first, I'm going to tell everybody to please subscribe. It helps our YouTube presence, and we really appreciate it. So, Sean Mullaney, why don't you introduce yourself and tell us a little bit about what you do?
Thanks so much, Bridget. My name is Sean Mullaney. I'm a financial planner based in Los Angeles, California. I have my own solo firm, Mullaney Financial and Tax, and I recently released a book, Solo 401k, the Solopreneur's Retirement Account, and I'm excited to talk a little solo 401k today.
That's awesome. So I mean, it's exciting. Thanks so much for being here, Sean. And actually to talk to the guy that wrote the book, right, on solo 401ks. And let's just maybe start out by talking a little bit about what that means for people. Is, again, a lot of folks, right, like a big company 401k plan, solo 401k. What are the differences? How does that work?
Yeah, so what we need to think about is self-employment, and that is growing by leaps and bounds to my mind. Whether it's full-time folks like myself who do self-employment full-time, or it's side hustlers, right? We're seeing a lot of interest in side hustlers, particularly among younger folks, but among all ages. And what it is it's a 401k for when you're self-employed. And I think people start out and they say, wait a minute, 401k, that's a huge retirement plan, right? These, multi-million, billion-dollar enterprises have 401ks. How can I, as a solopreneur, have a 401k? And the answer is that it's actually pretty simple, right? If you don't employ other folks, generally speaking, there are very large financial institutions that offer the solo 401k, which essentially has very similar contribution limits to what you might see at a workplace 401k. And in some instances, it can be a lot higher depending on how the math works.
Yeah, and so one of the things that I know I talk with folks about, or I hear is, and you kind of described it, Sean, right? It's for these giant companies. How can I do that? And the other thing is, but man, that's really expensive. I can't afford to do that, right? Like that's, and for the, the 1,000 company employees, yeah, it probably is pretty expensive. Not so much the case with the solo, right?
That's right. So with the big plans, they have these things called anti-discrimination testing. They have to make sure that the lower compensated employees are represented in the plan in terms of contributions in a fair and equitable way vis-a-vis the executives and those sorts of people. Well, in a solo 401k, there's no one to protect, right? So there's no other employees that we're worried about. Now, we can have a solo 401k potentially with our spouse or our business partners, but generally speaking, if we have full-time employees, we can't have a solo 401k. So many solopreneurs have no employees, so it's not much of a gating issue. And so once that happens, I think the financial institutions see this as sort of a way of getting in the door of, hey, you know what, if I can get Johnny as a client and he can contribute his 22.5 every year to his solo 401k, great. But he might have his other brokerage accounts, his other IRAs with us. Yeah, we don't have to charge much in fees. And so that's what I see, in fact. So there are large financial institutions where the only fees you pay are the fees in the mutual funds themselves, right? It doesn't erase those fees. But in today's world with index funds, there are a lot of low-cost investment options. And I think the approach the financial institutions are taking is, well, there's nobody to protect here, so we don't have that much in the way of compliance. We don't have to charge these excess fees. What we could do is just sort of say, hey, it's a way of getting people in the door, and then they'll invest with us for other products. So I think that's what we're seeing.
Yeah, and one of the things that I see with solo 401ks is that when you get a regular 401k at a company, you have your list of, I don't know, generally like 5 to 25 different investments that you can put it in. And that's it. And so some of them are kind of bad. I hate to say this, but we look at them and we're like, oh man, we roll our eyes. Totally different situation with solo 401k. You get whatever this brokerage house offer. So for instance, we use Schwab. Whatever Schwab does, you can put in the solo 401k. So it opens it up quite a bit. And so, like to whatever, you don't have to roll your eyes. You can buy whatever you want. I mean, within the rules of 401ks, but it's much broader. That's just what my point is.
Yeah.
Yeah,
So,
I think
what,
of it as both a feature and a bug, right? So the bug
Yeah.
is HR doesn't email you on day one at work and say, hey, here's the 401k plan, please set up your investment allocation, right? So that's a bit of a bug. But the feature, like you're saying, Bridget, is this. You get to decide, right? You get to decide the financial institution, the investments, you have their whole menu, generally speaking. Now, sometimes they limit it a little bit, but the limits I find are not very bad at all. So it's really more of a feature than a bug.
Yeah, I love that idea, Sean, of, it's a lot of good things, right? But there's always something on the other side that you got to be aware of too, right? To be smart about that.
One thing I would say that I caution clients with is that it isn't as, you want to take it a little bit more seriously, the application process, than you would with a lot of accounts. So I want people to save the application, which again, doesn't seem like usually something you need. But just in case this goes from a solo 401k into you hire employees and you want a real 401k, then you can convert the plan. There's reasons you want to be able to look at the original application and look at what your actual original plan documents are. And typically setting it up takes a little bit more time than with your typical account. Like your typical account, like on Schwab, it's just like click, click, click. Here you go. Here's your account number. With a solo 401k, it's more, you got to put in more information and there's more questions. You kind of scratch your head a little bit. Might have to ask them a few questions, but then again, save the application, save a copy of the application just in case. I know that's a weird, I don't say that with other stuff, but I would say that with this.
Bridget, I agree with you. I sort of view it as, I think about some of the administrative tasks of life, right? Getting a driver's license, getting a passport, signing up for the SAT, right? It's not like a Roth IRA. You can set up a Roth IRA on your phone in like 5 minutes, right?
Right.
This is more like, hey, we got to make some decisions. It is not, we're not splitting atoms, but yes, it's a little more administratively complex. One decision you have to make is, do I want a Roth component in my solo 401k, right? And that could be the right answer or the wrong answer, depending on your wants, your needs, where you are today, where you want to be tomorrow. Some plans don't offer the Roth component. I think eventually a lot of the plans will, but some plans don't. So you just have to shop around a little bit. Hey, if I want a Roth component, maybe I got to go look for a plan that offers it. And then when I'm in that plan portal, I got to make sure I affirmatively elect, oh yeah, make sure I have the Roth component in this plan too.
Sean, we talked a little bit about 401ks from the solo standpoint versus the big 401ks. One of the things that we've seen a lot are plans for small businesses like SEP plans, simplified employee pensions. And in the old days, the pitch was low or no administrative costs, sort of easy to use. Why is a solo 401k a competitive alternative to those sort of SEP and other similar plans?
Yeah, great question, John. And the reason is the solo 401k offers two different types of contributions. One contribution is the employee contribution, which today, if you're under age 50, is $22,500. It's a lesser of self-employment income, W-2 income, or that 22.5 number. So that's a big number. Plus, the solo 401k offers an employer contribution, which, depending on your business structure, could be 20%, 25% of your earnings. So those are two big numbers that can go into the solo 401k each and every year. That's fantastic. SEP IRA, look, a lot of folks have had success with SEP IRAs. The problem with the SEP IRA is that it only has one type of contribution, and that's the employer contribution. So say you're at $100,000 of Schedule C self-employment income. I've run the numbers, for a solo 401k, you could max out like 41,000 of total contributions. It's about 18.5 and a little change if we're only doing a SEP IRA. So look, if you're making $1 million, they both can have the same limit. But if you're more typical, you're making 80,000, 100,000, 120,000, the solo 401k limitations are going to be so much higher. And I think for that reason, for so many use cases, the solo is the better option than the SEP is today.
I just wanted to put, I really appreciate that employer and employee and put it into terms. If I work for a bigger company, right, it's a similar thing on a watered down basis. But when we talk about that employee contribution, that's what for many people, it's I sign up with my plan, right? HR gives me the thing and I can defer income and I can put what I want to in it up to that 22,500 cap. And then a lot of times I get a company match, right? My company match is 3% or 5% or some number of my salary. That's that employer part. But in this case, I just want to make sure I heard that correctly, is that you can put in up to 20% of your salary or 25%, right? So that's where you get that big number of 42,000 or whatever exactly it was.
Yeah, well, for about $100,000 these days, it's
Yeah.
about 41,000. John, you bring up a great point about a real advantage of going out on one's own is the solo 401k employer contribution, right? So when you're at work, you're limited by their plan. And look, they're in a business, right? So they just can't give away money to their employees. So they say, look, we want people to save for retirement. We want to be competitive with our benefits. So we'll match, dollar for dollar up to maybe 5% of salary. Well, that's great. 100,000 of salary, 5,000 of employee contribution. That's fantastic. But when you're on your own, you're limited by two things. You're limited by your cash flow and by the IRS, the Internal Revenue Code, those limits, right? And the Internal Revenue Code basically says if you're a Schedule C self-employed person below certain levels, you're basically limited to 20% of your net self-employment income. So 20% where I come from is a lot more than 5%. You have to run some machinations with the payroll tax or the self-employment tax. You get to in $100,000 of Schedule C profit, a little over $18,500 of employer contributions, which is almost 4 times what the W-2 worker at the large employer gets from their employer. So that's pretty good.
What sometimes I've seen that when new clients are coming in the door, a lot of times their tax preparer hasn't told them about the solo and 401k option, and they have a SEP. And I just want to let people know that it is available, and that the reason the tax preparers aren't necessarily thinking about this, they're not necessarily up on the latest investment vehicles. And I look at it as like, I'm a Civil War buff. And during the Civil War, germ theory had kind of been known. Like some people were thinking about, oh, there's germs and we should wash our hands. But a lot of people were objected to it. Like, I don't need to wash my hands. I don't believe in that new stuff, and before surgery, and so actually a lot of people lost limbs and died because like it took 20 years to adopt germ theory. And it's similar to that I would say that individual 401ks are kind of similar. Like it's taken a long time for people to adapt and for the word to really get out. Now, the last thing we want to talk about is where does this apply the most? So I see it we talked about side hustles already, but another case is one employee, you have a couple and one spouse makes a lot of money and the other person has their own business. Okay.
Yeah.
Why don't you tell us about that strategy?
Yeah. So the use case there would be, one spouse, W-2 worker, maybe a partner at a professional services firm, that sort of thing, where the income is in the high 6s, maybe in the low 7s. And then the other spouse, maybe has a smaller self-employment business, right? With the solo 401k, you can deduct almost dollar for dollar the entire, Schedule C income of that other spouse. And considering that the higher earning spouse has kicked them into the 37% bracket, you're now getting a 37% deduction on every dollar you're putting into the solo 401k, plus some state tax savings potentially. So I think that's a really good use case. There could be good use cases for single folks too, especially for your, folks like us, maybe financial planners, lawyers, engineers, folks who have their own solo practices, and maybe the income is in the lower 6 figures. There are cases where there's this thing called the qualified business income deduction, where perhaps you're making too much. You do a traditional deductible solo 401k contribution, you get to deduct that, and you open the door back up to be able to deduct that qualified business income deduction. So those are some of the use cases. You mentioned the side hustlers, where it's, hey, we've got a workplace 401k, we coordinate that with our solo 401k, and it's a way to sort of, optimize on two ends of the rope, so some really good cases out there. And because they're pretty simple to set up, the costs are low, it's certainly worth looking into if you have self-employment income.
That's great. Hey, thanks so much for sharing this information, Sean. It's been really informative. Again, then this is Bridget Sullivan-Ramel, and she runs a practice down in Chicago, Illinois. I'm John Shear. I run a practice in Middleton, Wisconsin. And the solo 401k for somebody that runs their own business, doesn't have employees, a really great thing. Sean Mullaney has been our guest here, Mullaney Financial and Tax. Sean, if people want to get in touch with you or order your new book, how do folks get in touch with you?
So you can get in touch with me 3 ways. I have a financial planning firm, MullaneyFinancial.com is the website. On Twitter, I'm Sean Money and Tax. Or you can go to my blog, FiTaxGuide.com. It has links to the book. I blog about tax and financial independence there.
That's great. We'll make sure to get those in our show notes. And thanks again, Sean. I really appreciate it.
Thanks so much for having me, guys. Really appreciate it.